Hi guys, in this part of the market profile educational series, we are going to continue with where we left in the previous tutorial. That is, we'll be starting the opening of a profile, let's say for a day or a weekly profile, the opening of any profile with respect to the previous profile. And again, we are doing this thing to gauge the confidence level, the conviction level of the other time frame trader. This is our main focus, and anyone who's trading, main focus has to be getting aligned with where the money is flowing in, getting in line with the positional guys. Trading becomes a lot easier then. Alright, so let us begin. The first kind of for the types of profile openings that we'll see is open drive, open test drive, open rejection reverse, and open auction. And these are the four types of profile opening. And again, we are doing this thing so that we need to know whether the other time frame trader is serious about putting his trades on the table, or to put it simply, it is to see if the other time frame trader is initiating a trade or not. We are not interested in other time frame traders responsive buying or selling activity. We are more focused towards their initiative or initiation of their trading cycle, whether it's on the long side or the downside. Now the key to gauge this is whatever profile opening we have, we need to compare it to the previous day's range, that is high minus low, and the value area. Now if a profile opens higher than the value area, it's good, but if it opens higher than the value area and the range, then that means the market is highly imbalanced, and that is a sign that other time frame traders are aggressively present in the market. Alright, so let us begin with the first profile, that is profile opening, that is open drive. Now open drive kind of opening is the opening where the other time frame traders exhibit the maximum confidence. Market just opens outside the range, usually outside the range of the previous profile, and it just continues to move ahead in the direction of the breakout. Usually the low made in the first 30 minutes, that is I'm talking from the intraday perspective, is not breached, and the range established in the first 30 minutes is usually not touched. The prices do not come inside that range, but this is an ideal situation. Usually it does not happen, so we need to accept the fact that sometimes prices will come in, but it can still have an open drive opening where the market just continues to move up. Alright, one thing that is important in this situation is I explained the 30-minute concept, that the first 30 minutes is not touched. If you're taking a weekly profile, then Monday opening, the low of Monday opening will not be breached. So you just got to adapt according to what time frame you are referring to. All right. Okay, so this is an open drive where what happens is, see, the previous value area is here, the range, the D profile, and the that is the beginning of the A profile is here, and the market just opens here. It just auctions little down, and then it just takes off. This is open drive, and it shows that other time frame traders are highly convinced about the direction of the trade, and they keep taking the trade higher. All right, if we look at the bar chart of it, now let's say some of you don't have market delta or any other market profile software, the concepts can be applied, but yes, when you're using a software like ME Broker or Metastock or eSignal or anything, you need to calculate the value area on your own. That is why I say that it's always better to, you know, use a software which can plot the market profile data. So see what happens here is, this is the opening range, first 30 minutes. Prices do enter this range, but that's alright, and then there's this one-way direction. Okay. The ideal scenario is where the first 30 minutes entire range, the prices do not enter. These prices do not enter this range, but you know, it's very hard to find such profiles now, especially given the phenomenal rise in number of participants in the market. So a little bit adaptation is required. So I won't emphasize too much on rigid rules here. It's got to be flexible. Okay, the second opening of a profile is the open test drive. Now open test drive is similar to open drive, only that the prices do not rally straight away. They usually open above the previous value area and the range, and the prices usually stall. They come and test some reference point, let's say a previous day high or the value area high, and then again start moving in the direction of breakout. Now in level of confidence, if you see, then open drive has the maximum confidence, then open test drive. Open test drive when compared to open drive has less confidence, because see here we are having retracement. Alright, and retracement means sellers are successful in pushing the prices back, and buyers are not that aggressive, because if buyers are aggressive, then your retracement will be extremely limited, and the prices can just move away in one direction. Alright, the previous reference area which I talk about, where the market comes and tests whether there is some activity below that area or not, can be anything. Like I said, it can be a value area high, a previous day high, a previous pivot level, or anything. I mean, let's say a previous range, that is previous day's range. So just be careful about that. The various reference point is something I'll cover later. But most of the times what I have seen is that either the value area high is touched or the previous day's high is touched. That is what happens. So these are two favorable points where market comes down. Now once this test happens and the traders are convinced that there is no activity beyond the reference level, then the market starts auctioning again in the direction of the breakout. Okay, so in this case, if you see, buyers are relatively less confident and they need assurance, and that is why the prices come down and then again it starts moving up. Okay, now let us take an example. Yeah, if you look here, see again, this is the initial balance of the previous profile, this is the value area. Okay, this is where the prices have closed. Now look what happens. The opening is here, that is O. The market auctions down. It tests the previous value area high, or rather we can say it's testing the high of the previous day, and then it starts auctioning higher. Alright, let me check if I have a bar chart for it. Yeah, see what happens. This is the previous day's action. This action is similar to this profile. Alright, and this action is similar to this profile. So see what happens. The next day market gaps up, it tests the previous day high, and then again it starts moving in the direction of the breakout. Okay, so can you see what's the difference? This is open test drive, and here the traders are depicting less confidence, and just check out the open drive bar, see how different it is. The gap up is huge and the market just rallies, whereas here gap up is reasonable but the low of the opening range is disturbed, and then after some previous reference level test, the market begins to move higher again. All right. Okay. The next opening that we'll see is open rejection reverse. In this, what happens is that the market, opens higher, and it does appear that it's an open drive, and this is one of the most confusing openings, because what happens is at the first stage you see it's open drive, but when you see the first 30-minute low being broken, then you suspect that it may be open test drive, but eventually it turns out to be open rejection reverse. Now there are some hints that you get early on, which I'll discuss, but what happens here is that the price gaps up, it faces some resistance, and the price quickly rolls down. Now aggressive sellers enter the market on the top. Okay. But in this, what happens is the participants are less confident. Now how do you measure that confidence? It could be in the quantum of gap up. One could be that. Another could be, as soon as the price gaps up, you see a lot of sell orders coming in, and this is for people who watch it on time and sale window. The third could be that we could be in a bear market, let's say, where prices are trending consistently down, because these kind of opening happen in bear markets, not in bull markets. It's not that common. So let's see what happens. See, what happens is the price just about gaps up above the yesterday's range. The price quickly comes down, and then what happens, the previous value area is this. So by the time the prices are coming here, we still think that it may be open test drive, but once the price goes below the yesterday value area, remember what it is. This means that sellers are now initiating selling. Alright, so this is initiative selling. This is not responsive selling. Responsive selling is happening above the value area, previous value area. Okay, I hope this concept is clear now. So once this happens, the market just continues to go down. The odds are much higher when this happens in bear markets that this will happen. This is one of the most frustrating profile openings that can be there for, let's say, someone who's bullish. He's expecting the market to move up, and it just suddenly reverses. Alright, let me see if I have a bar chart for this. Yeah, so see, this profile, it's this action. Alright, and this is for this profile. Alright, now see what happens. The market gaps up, and there's a previous resistance out here. It takes the resistance and just keeps going down. It's always not so beautiful in structure, but it's enough to profit reasonably well. Again, these kind of swift actions happen in bear market, and once we are approaching the end of this tutorial, I'll just brief up upon which kind of market a particular opening happens. Okay, we now move on to the last section, which is the open auction. I've purposely kept this tutorial very short because I wanted to dedicate one particular section to the opening of a profile, since we'll be studying a lot of long-term and short-term profiles. So I wanted to keep this section separate so that it doesn't get mixed up. Anyway, the last kind of opening is the open auction. Open auction, it refers to a market which is absolutely listless, which has no activity at all. And this happens when the price is opening within the value area or within the range of the previous profile. Okay. Usually it happens that way. Now if sometimes even it happens that the market opens within the previous value area and range, and then later on, it moves out of the range. And I'm not talking about normal variation day. I'm talking about, let's say, market opening in the A interval, and towards the end of the A interval, ATPOs, the market starts to just break away the range on the upside and downside. So then you would know something has changed. It would be something like open drive but without the gap up. Okay, remember one thing, here we are measuring confidence, conviction. The gap up indicates conviction, whereas opening within range and within value depicts less conviction. So this is a small clue that we get. All right, so let us check this out. Now look, this is a profile. The market opens here. It quickly tries to go beyond the range but is unsuccessful, and it trades listless around the previous value area and previous range. These kind of profiles will mostly happen in bull markets. Okay, but I'll just come back to that later. Okay, I don't have a bar chart for this. Anyway, it's okay. Now let us revisit the profiles. Yeah, okay, the first one was open drive. Now let me tell you when open drive happens. Open drive happens when it mostly happens when volatility is high. If you have ever experienced a bear market cycle, whenever the market becomes too bearish, you see the next day it gaps up and opens, and it just continues. The short covering rally continues. I mean, because see, there's a saying that bull markets climb one step at a time, whereas bear markets they just fall immediately. Similarly, the counter rallies in bear market are extremely swift. They just take off vertically. I'm sure many of you have experienced that. So open drive usually happens that during that phase. Also in bull markets, if you want to spot open drive, then more commonly you'll find open drive in places where the market is down for like 6 weeks out of 8 weeks. Still there's bullish cycle, the valuations are cheap. Suddenly you will find that the market gaps up and it goes up. If you check this scenario, it happened I think in August September 2012. I think from 5300 the Nifty retraced to 5300 and immediately it gapped up, and I think it happened in September. I'm not sure. So it happens on some major news announcements also during bullish markets. This happened somewhere around when the FDI retail was announced. Such event happened. Alright. The next that we see is open test drive. Now open test drive is the kind of profile opening which mostly happens in bull markets. Because just think of it. The market gaps up, then suddenly the market is giving a message, no, I'm not sure of going up. It retraces back. The people who have entered the positions on gap up opening, they get skeptical, they get out, but then eventually again market starts rising. I hope you're starting to link it. So these kind of openings are mostly in bull market in low volatile conditions. Alright, in extreme low volatile conditions. Now open rejection reverse, I've already said that this kind of opening happens in bear markets more often when volatility is high, because look, a market won't just gap up and immediately start going down in 2-3 periods. It only happens when the volatility is high, uncertainty is more. So in this kind of, usually these openings lead to formation of neutral days, where the initial balance is broken on the upside first or the downside first, and then suddenly the market reverses and goes back in different direction. So see, a lot of volatility out there. So these kind of profile openings are in bear markets. Now if you see the open auction is when it usually happens in bull market. It happens when volatility is low, the market has run up fairly strongly, and then everybody's expecting a correction, but the market continues to consolidate, buy some time, and then again it starts moving up. This also happens during distribution, during the top of bull markets. Volatility does not start to increase. Market just begins to trade sideways, and usually during that time when the volatility is not high, rotations are happening, these kind of profiles will form. Alright, so now coming back to linking this with your technical system, how would you do it? Now let's say we are in a bull market and volatility is reasonably low, you get a breakout. You gotta see where your previous profile, the value area and the range is, and where your current profile opening is. Now if your system is giving a good breakout and you see the profile opening is above the previous value area and range, you immediately know that the OTF trader is in control, so you can enter it. Whereas if you have a breakout within previous profile range or the value area, the volatility is low, there are more chances that it would be your open auction kind of opening, so you can wait it out. Alright, I hope you're getting it. Similarly, if you see the volatility is high and you're getting a breakout, you gotta be careful that you could head into a open rejection reverse kind of opening, and hence what you need to do, especially if this happens in bear markets, is you can buy protection in options, or you can hedge in some other way. Especially the Indian markets do not provide a lot of instruments for hedging, so I think options is the best way to go about it. Now if you take a volatile environment where volatility is not that high or not that low, but you still see your trading system gives you a breakout, what you can do is you can wait it out, and always you would want to see whether in the first few intervals, let's say the ABC period, whether the market moves out of the range or not. If you're suspecting the market will move out of the range, this is when it's opened within the profile and the range, then you can bet aggressively. But if you see during the ABCD rotations market is not moving out, then either you can wind up some positions or write options, write calls or puts depending upon the bias, and get some premium out of the market. So this is how you can strategize with the kind of opening and your current system. All right. I think in the next section we are going to discuss something on value areas. I'm not sure. I haven't looked at it. But anyways, I hope you're beginning to get the concepts by now. Start looking at the chart. Please get active in some discussions, because a market profile learning curve will increase dramatically if you discuss on a daily basis about these things. And one thing specifically I want to tell everyone: don't worry about being wrong. Trust me, the more often you get it wrong, the more you'll train your brain to correct your mistakes, and the sooner you'll pick up this technique. All right. Okay, guys. Until next time. See you. Bye.